If you have an interest in investing, making money, saving money, working, I believe one of the most important things you have to understand as you begin your journey is to understand the impact of inflation on your ability to create wealth, but more importantly, on your livelihood. Financial education is something that we all need. It's something that I know that if you're listening to this, you have an interest in. And I, in many ways, was inspired to put across some ideas and thoughts about inflation, primarily because I came across some information every year. The inflation rate is published. For 2019, it's 1.8%. Now, if you saw that number, you would feel that that is the real inflation rate. What I want to share with you today in this session is to explain how that number is incorrect, but more importantly, how you should go about calculating how inflation is affecting you. I believe that inflation is like gravity to your ability to create wealth. Therefore, one of the most important things you have to understand is how inflation affects you. The way inflation affects me will be very different to the way it affects you. And in today's session, I'm going to be talking very quickly, very briefly, about inflation and how it's intrinsically linked, inescapably linked to wealth and your ability to create wealth. You cannot separate both. If you have an understanding about investing, one of the most important things you always want to keep in mind is the time value of money. And let me explain it in this very simple concept. £100 in my pocket today will not be £100 in purchasing power in 12 months. Now, let me say that again. If I have £100 in my pocket today, in 12 months' time, the value, the purchasing power of that money may have increased or may have decreased. The direction that it goes, either increase or decrease, depends on how the economy is run. It depends on so many what we call macro factors. I'm going to be explaining why inflation is important to you and how you must, I would say, position your portfolio, how you must adapt your lifestyle, how you must perhaps make subtle changes to your wealth creation plan to ensure that it's not a drag on your ability to create wealth. In January 2019, like in January of every single year, there is a statistical number that's released. It's called the inflation rate. In the UK, we call it the Consumer Price Index. Nowadays, it includes something called housing. That Consumer Price Index, called CPIH, when it includes housing, is equivalent to the inflation rate for that particular period. The period in question usually looks backwards, 12 months before. So what in principle happens is they look at the cost of the goods that most consumers will use in various areas: transportation, energy, general, domestic consumables, even your housing. And they collect information between a period in time and they try to find out what has been the change. Has the cost of goods increased? Has it decreased? In 2019, the number is 1.8%, a reduction from 2% in December 2018. Now, if you looked at that number, you would think, well, inflation is not that high. Well, it's a very, 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 what I call deceitful representation of the impact of inflation on you and I. And I'm going to explain the reasons why, but more importantly, I'm going to try and explain how you and I can position ourselves to ensure that we're not victims to the inflation, what I call depletion on our ability to create wealth. Now, that 1.8%, just so you understand, now, it doesn't matter where you are, it doesn't matter where you're from, it doesn't matter where you were born, it doesn't matter what you do, inflation affects you. Because if you use money, inflation will affect you. Now, part of the reason I think this is an important topic is simply because the average person if you exclude those who are actually still at the very young age, maybe teenage or adolescent age or stage of their lives, if you exclude that group of people and you exclude those who are in principle either in the age of retirement or have gone far into the retirement period, you're left with a pool of the population who spend most of their time working. On average, we spend, if you exclude the time that it takes for sleeping and resting, we spend more than 70% of our waking life working. 24 hours in a day, assuming you exclude 8 hours, that's 16 hours left. Out of the 16 hours, we spend about 8 hours at work. But if you include the time we invest in getting ready for work, preparing, traveling to work, traveling back from work, it turns out that we spend between 12 hours and sometimes 13, 14 hours out of the 16 hours left in relation or in connection to work. And for that reason, we spend a great proportion of our time working. One of the important things we have to do is stop and say, well, what am I really working for? Because if you don't stop and ask that question, then you're like what I call a rat on a wheel. You just keep going and going without really stopping and saying, what am I getting back for all this labor I'm putting in? Today's session is intended to help you probably take stock and see how the macro factors around you are affecting your ability to create and keep the wealth that you've worked really hard for. When I looked at the information from what's called the Office of Statistics, they are the body responsible for creating and producing and releasing the information about the inflation changes every year, I noticed something quite interesting, and that's what I want to talk about. The 1.8% is slightly misleading because, in principle, although the process through which it's calculated is correct, for each and every one of us, our inflation rate is different. And the reason is simply because you and I live very different lives. And the way you live determines how inflation affects you. Likewise, the way I live determines how inflation affects me. But I'm going to give you some ideas about how that number is misleading and how you should try and calculate your exposure to inflation. Now, I looked at the number and I said to myself, that's impossible. So I just said I would wait. About a month later on, I received a number of statements. I'm going to focus on just about 4 or 6 what I call utility statements that I received, which is your bills, your invoices every month. I received a statement on my gas and electricity. I received a statement on what we call council tax, which is a payment we make. If you're not based in the UK, you might be wondering what that is. It's simply a payment we make depending on where you live. It's a contribution everyone makes towards the local council, and they, in principle, will deal with many things for us. Cleaning the streets, taking out the garbage. Effectively, we collectively contribute money to get civil servants to do for us what we can't do individually by ourselves. I received a bill for my water. I received a bill for broadband and my telephone line rental. Very basic things that most people would have. If you are a homeowner, you might have your mortgage. If you rent, you will have your rental invoice. And I looked at each and every one of those utility bills. What I noticed was when I looked at the Office of Statistics information, they indicated that between 2018 December and January 2019, a lot of the spending a lot of the items that we spend money on, such as energy, had reduced. Now I found something quite interesting. On my utility bill, my energy and my electricity bill, my electricity bill had a statement saying, well, for 2019, the cost of energy is increasing by 12%. On the gas, it had a statement that said that the cost of gas is increasing by 10%. I thought that was quite interesting because when I read the Office of Statistics inflation report, it said that it had reduced. That got my attention. I then made an effort to look at the other utility bills. On the water side, I noticed that the water had increased. My telephone line rental and broadband had increased. And so I sat down and I did a calculation. And what I found out was just looking at the basic utilities without looking at food, just looking at utilities, electricity, gas, water, broadband, telephone line rental. I excluded housing, but just looking at those key areas, I calculated that the inflation rate increase for me in the last 12 months was about 8%. Now, this doesn't apply to me alone. And the reason is simply because if you live in London, you're probably supplied by the same energy supplier. So your increase in electricity and gas is similar to mine. If you perhaps use the same water services, which if you're based in London is the same, your water bill increased by the same amount. Likewise, if you're with the same communication supplier, your increase in your telephone line rental or your broadband was the same as mine. So this is not a particular case applicable to myself alone. Now, I found that really fascinating. I had a number of 8% when I did the calculation, but the inflation rate reported was 1.8%. Now, one of the things I would like you to do is, if you can, just take the time out and just look at your latest statements and see what your number comes to. Now, I didn't include general goods in terms of your consumption, because you and I have different consumption lifestyles. But I can make a promise, and that promise is that if you go through your cost and your spending and what you spent a year ago compared to what you're spending now, and you look at the items you spend, you buy, or you spend money on every single month or every single week, one of the things you notice is that there's been an increase between 2018 and 2019. And I can promise you it's much more than 1.8%. Now, what is the point of all of what I'm trying to say? Well, this is it. Assuming that I was to go with 8%. Now, I will say this, that the 8% figure that I calculated in my case, well, it came out to roughly about 7.85. I rounded it up to 8% just to keep things simple. That number is a weighted percentage, meaning, for example, if my council tax was 4.3%, but I was paying a certain amount, and my water bill was say 3.5%, and I was paying a certain amount, and my gas and electricity was 10 and 12% respectively, and I paid specific amounts. I applied what I call a weighting. So you weight each of those, because for some of your utility bills you're paying much more, for others you're paying much less. So you take the weighted average, and it came out to roughly 8%. Now, what does that mean for me? Well, one of the most important things you have to understand if you want to create a financial future, is you want to understand what's called the time value of money. And the time value of money simply means that if I have £100 today, in 12 months' time, the purchasing power of that same money would have reduced or increased, depending on what's happening in the economy. Typically, the way the inflation rate is calculated, it doesn't take into account the impact on when we increase the money supply in any particular time period. What that simply means is, whilst I've calculated my inflation rate based on the cost of the goods that I spend my money on, based on my lifestyle, has increased by 8%, that doesn't take into account the fact that in the last 12 months, the UK government may have authorized the printing of additional funds for whatever reason. Every time the government prints money, the purchasing power of what you have is devalued. So there's a correlation between the amount of money printed by the central bank, if you're in the US by the Federal Reserve Bank. There's a one-to-one relationship between the amount of money printed and the effect it has on inflation, and the effect it has on the money you have either stored in cash, if it's in a non-income producing asset, or in an appreciating asset. If you're just storing money, it's saving money, what you have is depreciating. That's why the time value of money is really important. It simply means, if I have £100, using the same analogy, and the government approves perhaps maybe a 700 million or 700 billion pound what's called a stimulus. If the economy is going through a downturn and they need to stimulate the economy, if the government approves that spending, once they approve that spending, that money is injected into the economy. It simply means that the quantity of money in circulation increases. What that simply means is that you have much more money pursuing the same assets or the same products or services, and therefore the prices will go up. This is just basic economics. What that means for you and I is simply that the money we have stored in a currency, if we have money in a currency, that currency is devalued. The more they print money, the more the currency devalues itself. But I'm not going to deal with that aspect because that might be perhaps too much for you to take into consideration right now. What I would like you to do is take some time, and this is not a trivial case, and I don't want you to treat it that way. I'd like you to take some time and just sit down and itemize what you spend money on. I'd like you to exclude, for now, the money you spend on consumer goods, such as maybe your clothing, such as your spending in terms of food. Just put those to the side. You can come back and do those later on. I'd just like you to look at your basic expenses, water, gas, electricity, and any other utilities that you have, and just calculate how much that has increased in the last 12 months. When you have that number, that represents your inflation figure based on your lifestyle. It may not be possible for you to do the same with regards to your spending on consumer goods like your food. But if you could do that, it would be interesting for you to actually calculate that amount as well. If you could do the same thing for your housing, if you have a mortgage, then in principle, maybe depending on whether you have a fixed or variable mortgage rate, if you have a mortgage, then you might not be affected that much. But if you rent, you may be lucky that where you rent, there has been no change. If there has been a change, take that into account. Calculate the total amount increased in the period, say 12 months or 18 months or 15 months. That number represents your inflation rate based on your lifestyle. Now the question is, what do you do? I'm going to use myself as a good example because I've done that calculation in parts. Using the 8% that I mentioned earlier on, what that simply means is that every year, the purchasing power of what I have in currency is depreciating by 8%. If I had £100 at the start of January, then by January the next year, I cannot buy the same quantity of goods using the same £100. So I have a choice to make, and this is where I would like to perhaps share some of the ideas and some of the things that I'm doing that I think might be useful for you as well. Remember that I don't want you to simply follow my recommendations. I don't want you to reject the information I'm giving you right now. I don't want you to neglect it. I don't want you to accept it. What I like you to do is just simply welcome it, take the information away, think about it, ponder on it, and think about your lifestyle. And ask yourself, can this information help me in any way? If the answer is yes, then I welcome you. And it would be an honor if you actually apply them. If the answer is no, it won't help me, I don't need it, then by all means, I'd like you to just discard this information. Perhaps it's not for you right now. Using myself as a reference and using the 8% figure that I calculated, what that meant, what I said to myself is that for me to just break even, for me to stay even, I have to be making 8% more. On every pound that I have, I must make 8% every year, because if that number stays at 8%, it means it's depreciating. So just to break even, I need to be making 8% return on my investment, or I need to ensure that my currency saved, invested, stored is making 8%. Now there are multiple ways in which you can actually beat inflation. Number one, you can take an active approach. An active approach simply means that you invest your money. There are two ways that you can go about this process. You can do it in a passive way, you can do it in an active way. If you're doing it in a passive investing pathway, it simply means that you will find, and I'll use an example, say that a stock indices or any form of indices in your local country. Here you have to study the markets. I'll use the UK as a good example. I'll use the US as a reference also. In the UK, we have something called the FTSE. It's the Financial Times Stock Exchange. It's similar to the US, where they have something called the S&P, which is the Standard & Poor's. And both are indices, and those indices simply have all the public companies within a certain market capitalization rate. It simply means, for example, in the UK, I can choose to invest my money passively in all of the companies that are public companies in the UK. I can also choose to invest in the 500 companies in the US. You may have heard of something called the S&P 500. That is simply the 500 top companies in the US market. In the UK, I can do all companies, which would be the FTSE, all shares. I can choose the FTSE 100, which are the top 100 capitalization companies. I can choose the FTSE 250. I can choose the FTSE 350. What I'm simply saying is I don't have the knowledge, I don't have the ability, and I don't really know how to select the companies that will ensure that I make at least 8%. So therefore, I'm going to spread my money evenly across all these companies. I'm not going to be buying and selling and buying and selling. I'm just going to allocate my resources each month. I spread how much I'm going to invest for the whole year. And every month I buy a fraction of the index or indices. That's passive investment. The active approach could be where I say, well, I have the knowledge, I have the know-how, I have the ability, I have the skills, and I'm going to intelligently sit down and I'm going to select companies that I believe will provide me with a return greater than 8%. That is the first path. That is where I decide I'm going to take an active or passive approach to ensure that I'm achieving a return on my investment greater than 8%. If I can do that, then I break even. It means if I make 8%, I'm breaking even on inflation. If I do more than that, I'm doing much more than inflation can affect me. It simply means that I'm doing well. That's the first path. The second path is where you say, do you know what? I don't like investing. I just want to save my money. I don't trust the stock market. I don't know what they do. I don't understand the game. I don't want to invest in real estate. I don't want to invest in commodities. I don't want to invest in any other form of asset class. I'm just going to keep my money in a currency. That's the second option. There's nothing wrong with it. It's just the second option. The first option is where you choose to invest. You choose the asset class. I gave you an example of investing in stocks. But you might be knowledgeable about, who knows, maybe real estate. You might be knowledgeable about other asset classes. I'm not going to go into each of those in this session. The point is, you can choose to invest. That option, in my opinion, is the best option because it means you have a fighting chance of beating inflation. Second option is where you say, I don't want to do investing. I don't understand it. It's out of my area of competence. I'm just going to save my money. If you're saving your money, unfortunately, you have to accept that the currency you're saving will depreciate over time. What you must now do is be intelligent about how you save. And that could be you go to your bank and say, do you know what? I'm going to put my money in a long-term saving account. In the UK, we have opportunities whereby you can put your money in what's called an ISA, which is an instant saving account. Depending on the time period you want to invest for, you might get a return of, who knows, maybe 1.5%, maybe 2%. It's still less than the inflation rate, but at least you're getting something. Such accounts are not typical saving accounts. So your savings account in your bank might pay you maybe 0.25% or 0.01%. It's really next to nothing. You have to go for a specific long-term saving account where they might give you something much more. They might give you 1.5%. Some might even give you up to 2%. Now, I know some who will give you up to 2.5%, but you have to be careful because those who offer much more offer, in many cases, there's a slightly increased risk. You have to read the small print and understand the conditions that they're getting you to sign up to. Don't be attracted by the high instant saving rate that you're going to get. Read the fine print. Now that's option 2. You just simply say, I'm going to save. I'm not going to do anything else. I'm just going to save. Now the third option is where I think you and I can make a difference. It doesn't matter how you live, where you live, what you do. This is where you can make a difference. And I'm going to give you some advice and some information that might sound counterintuitive, but I want you to just ponder on it and think about it. Don't make a decision immediately, just think about it. Inflation only affects you and I based on our consumption and our lifestyle choices. So if the inflation rate is 8% in my case, but check this out, and I use that 8% based on my expenses within a specific area of my lifestyle. I'm going to move slightly into the area that I didn't talk about. And let's talk about consumption, meaning how much I spend on food, how much I spend on clothing, because that's something you and I need, even how much I spend on shelter. But I'm going to focus on food and clothing. Your lifestyle determines, in many cases, the quality of the life you will have in the future. If you have a high consumptive lifestyle, unfortunately, you have very little to save and also very little to invest. I like to use an equation when I talk about investing. I say, well, if your outgo, meaning the money you spend, your outflow of money, exceeds your inflow, meaning the income you earn, then you have nothing left. You're in what we call a deficit. If, on the other hand, your outflow is less than your inflow of money, then you have what's called a surplus. So you have something left, and with what you have left, you can then choose to save, to invest, or to spend. So the key thing you and I have to do, if you just think about your lifestyle and say, well, how does money flow in and out of my life? I'm going to paint a picture for here using this analogy and see, I'd like you to just think about how it affects you personally. If you earn money, money flows in. You've worked for the money, but the first thing that happens if you are an employee is the money is taxed. So the first expense is taxes. The balance, the net, is paid to you. Your lifestyle and the lifestyle you've chosen, you have commitments. So for example, one payment you might make is the rent or your mortgage. That could be, in many cases for most people, is next to taxes, is your biggest invoice. So you pay taxes and then you pay your rent or your mortgage. The rest is then your lifestyle. It will be feeding, it will be transportation, it will be general upkeep, it will be maybe some entertainment, maybe some leisure activities, your lifestyle. Now, one of the things you and I can do is realize that maybe in your case, you can't really change your taxes and how much you're taxed. I like to show you how you can do that because I know that there are many ways, and I've tried this and I know what I'm talking about, and I can share with you ideas, which I won't cover in this session, on how you can reduce your taxes. Taxes for most people, is the highest expense. And by taxes, I'm not talking about just taxes that you pay based on your capital earned, either capital gains or capital or money you've earned by labor. I'm talking about taxes in its entirety, meaning taxes based on what you've earned taxes, but also taxes based on how you spend. So for example, whenever you pay money, if you're in the UK, there's what we call value-added taxes, which is 20%. Let's assume that you can't do anything about your taxes. And let's also assume that your mortgage is fixed. There's nothing you can do about it. The area that you can affect and you can make a change, and a drastic change, is how you live. Now, my intention in this session is not to get you to change your lifestyle. My intention is just to make you aware of how you're living and how your lifestyle is affecting the amount and the impact that inflation has on you. I would like you to just understand this. I'm not trying to change your lifestyle. I'm simply trying to get you to simply be more proactive rather than reactive. You see, because for a number of years, what I would do is I would spend, and then I would try and understand how inflation was affecting me. With the changes and the more I studied, the more I realized I could be more proactive. If you want to beat inflation, one of the ways you can beat inflation, number one, is to reduce your consumption lifestyle. I know it doesn't sound great, but that's one option. The second option is where you forward plan. You forward plan your lifestyle choices in such a way that you take advantage of the market. You see, the market goes through cycles. I'll use a good example. Let's say, for example, you like you want maybe a new pair of jeans. And you walk into the mall and it's on sale for maybe £100. Let's say that pair of jeans, if it weren't on sale, it would sell for £200. So in principle, it's selling for 50% off its normal price. If you just take into account that every year you buy one pair of jeans, every year one pair of jeans, it simply means that if you were just taking into account how much you would have spent over that 12-month period, if you're buying it at the original price of £200, it would mean that every month, if you were adding up how much you would save then to buy that pair of jeans, you're looking at something roughly in the region of about, who knows, maybe £17 every month, between say £16 and £17 that you would have to save every month in order for you to meet that commitment that you have at the end of the year. By buying it on sale, you save 50% of that, which is a great saving, 50%. Now, if you apply this principle to every part of your life, now it may not be possible when it comes to your clothing, because not everything is on sale always. But if you just come with that mindset and say, you know what, I'm going to try and buy my personal effects, my clothing, at the best possible price. One of the, I call it a head job. One of the things that most companies have done is they've used the hidden message of branding and marketing and sales, and they've clouded our judgment. Most of us don't actually stop and ask ourselves the question, do I need this or do I want it? And so we walk into a shop and it looks good. You walk into a shop, the lights are on, the people who are there, the sales staff are friendly, the music playing is really nice. Maybe you've seen the pair of jeans on television. It's all I wanted. So we go for instant gratification. If you can delay gratification, you have a great chance of actually beating inflation. Because for many of us, what we buy are not really our needs. We buy wants. Now, I'll say that again. Most of us spend most of our money on our wants, not our needs. What I'm dealing with in this section is simply your wants. All I'm simply saying is, be a little bit more careful. Forward plan if you're going to buy your wants. A pair of jeans that you're going to need in 12 months, you can forward plan. A pair of shoes you need in a few months, you can forward plan. Those are wants. Now, with your necessities or your needs, there's less you can do about it. But I'm still going to show you some ways in which you can actually make a difference. So my first advice is, if you can, just take stock of your consumption lifestyle. Just make a list of what you spend money on regularly. You'll be astonished